Hey everybody, I'm Joe Pizar and welcome to our Stein Wealth Advisors quarterly economic update. We had a very busy quarter this first quarter. There was a lot going on and we have a lot to cover, so let's get at it.
Yeah, thanks Joe. My name's Josh and I'm one of the partners here at Stein Wealth Advisors. And first I want to give a very special introduction to Stephanie, our newest team member here. Stephanie joined us almost 2 months ago exactly now.
Exactly.
And her main responsibilities are working on financial planning. So her actual title is the Director of Financial Planning. And she's helping with all of the financial planning work here at Stein Wealth, as well as sitting on our investment committee. So pretty much anything investment and or planning related, she's assisting with. And I'm sure many of you will get to know her very well, and we're really excited to have her on the team.
Well, Steph, we're certainly happy to have you on the team. Welcome. What are we going to be talking about today?
Awesome. Thanks, Joe. Yeah, I'm thrilled to be here. And I'm thrilled to talk a little bit about what's been happening here in the first quarter. Big macroeconomic topics we think are the most important things that have come up. First, of course, the geopolitical conflict overseas between Russia and Ukraine, inflation, which we know everybody's seeing at the gas pump and beyond. Cybersecurity issues, which are kind of widespread now and concerning to investors and all individuals alike.
Very busy first quarter.
That's a lot for one
We have
quarter.
a lot to cover here, so let's get at it and we'll try to keep this concise for everybody. So first thing we want to talk about are our economic indicators. We're happy to have these shared to us by City National Rockdale, and we think they do a great job of talking about the varying areas of the economy. And what you can see that drastic change between January of 2022 and March of 2022. We can see our indicators with monetary policy, interest rates, inflation, energy costs, and the geopolitical risk have changed. So we can see that there are pressure in those areas and something we want to be concerned about. If you want to take a look at the bigger financial indicators across the board, we can see that predominantly they're still in the green, which means that there's nothing inherently wrong, but that geopolitical conflict in Ukraine and the war in Ukraine is putting a lot of pressure on not only the tension in the markets, but also the commodity markets as well. So interesting ongoings and some interesting shifts from our economic analysts that we're looking at. All right, Josh, so would you be able to help us out understanding some of the more finite economic indicators in the market so we can see what's going on there?
Yeah, so as you can see in this slide here, what we're looking at are some of the key economic indicators, but more specifically relative to historically what their ranges are. And oftentimes it takes a little bit more interpretation into where data is relative to maybe where it's been in the past, not just where we are today. First one I want to point out, market volatility. I'm sure you've noticed, either looking at your statements or watching the news, it's been a rough quarter in terms of ups and downs. And as you can see from a historical range, that's true. We're pretty much at the peak of a typical volatility range. And certainly that's probably going to continue for some time. And the reality is, I think the markets are more volatile to the unknowns. And the slide before where we were talking about all the things that have transpired in the last quarter is a lot of unknowns. War, inflation, a lot of unknowns. And even if it's a negative, I think usually the markets respond less favorably to not being known that it is something that's potentially bad. 10-year Treasury yield is another one I'd like to point out. At the end of the month, it closed at about 2.3%, up significantly from the beginning of COVID. And really this is a very important indicator of a lot of other things. I won't go into too much detail, but we've spent multiple economic updates in the past talking about this. So if you do have an interest, you can go back and maybe listen to some of other updates. But that being said, historically, it's actually extremely low. We've just been in a low interest rate environment for so long that when we saw the 10-year Treasury during COVID go down to 0.5%, and now it's at over 2%, the velocity of that has a little bit of a concern. But big picture, long term, it's actually lower than it probably should be. So what does this mean? It means we expect rates to continue to go up by the Fed raising interest rates, in which case the 10-year Treasury will continue to go up. That's likely to happen. But at the end of the day, probably still within reasonable tolerances for historical averages. Home prices, I'm sure, is one that nobody is unaware of. They're off the charts high. I won't I won't go into too much detail about that, but I like to kind of show you visually how far inflated these home prices are based on typical ranges.
If you're trying to move right now, I think you know that one.
Yeah, oh, no question. And it's natural that as interest rates go up, mortgages become more expensive. So we would expect to have a little bit of downward pressure on home prices just naturally because of that.
Right.
An interesting one here, which is really the talk of everything, is inflation. And so the next one there shows just really how far away we are from typical ranges of inflation at 8%, give or take, and potentially even higher. Where the Fed likes to see inflation rates right smack dab around 2%. We've seen them as low as almost nothing, and we've seen it close to where we are now. But we've really kind of stretched further than certainly the Fed would like, and you're seeing that in your daily purchases as well.
Very quickly.
Yeah, one interesting one I will point out is despite high inflation, our unemployment number is actually looking really good. And coming out of COVID, where unemployment was certainly off the charts as expected, being shut down, it's come back very well, all things considered, and the fact that we're likely still in a reopening phase really only, I think, gives more benefit to having low inflation numbers and low unemployment numbers, and potentially even improving on those. And this may be a really good ace up our sleeve as an economy with a period of high inflation. Low unemployment numbers is really helpful. And if we were in a position where we had runaway unemployment with runaway inflation, that's where you start to get into these stagflation type scenarios, which are certainly never good. But with people working, even with inflation going up, wages are going up, that helps balance some of this out.
Can you walk us through some of these asset class performance numbers and who's doing well, and where are we struggling at?
Yeah, well, not a whole lot is significantly overperformed, but really primarily one major asset class being commodities, which I wouldn't say is a surprise, but over the last decade plus, commodities has had an extremely bad run. And not that you want to bet on the losers, because that doesn't necessarily mean that they're going to get better. But this was kind of the perfect storm for commodities with a war and inflation,
COVID, supply chains,
everything else going on. As we saw pretty much all asset classes go down, stocks and even bonds. Commodities was kind of the one asset class that started a nice recovery. Oftentimes commodities have been used for inflation hedges, although historically that hasn't always panned out well. But in this very specific kind of period we're in, at least over the last year, commodities has certainly kind of regained some of that traction. The one interesting thing to note is fixed income bonds are down. In fact, at some point in time, depending on when you looked at it, the bond indexes were actually down more than the S&P.
Surprising.
It's extremely surprising, extremely atypical. If you were to look at those typical ranges in kind of like the previous slide I showed you, that's not something that we normally expect.
Sure.
That being said, there's a lot of pressure on the fixed income market right now with runaway inflation and rising interest rates. That's caused a real big mix-up in the bond market. Is that a concern? For the moment, yes. But typically this level of divergence from the norm is generally short-term.
Right.
So it's certainly something we're watching, and it really makes things challenging from the perspective of how do you manage risk, because if we generally use bonds to be a less risky asset than stocks and they're not, that's a problem. But that being said, it's a pretty short period of time, and these things can happen. So certainly something unique and worth pointing out, but will that continue? I doubt for a significant period of time.
Yeah. Well, I'd love to say that's great, but very concise. We'll leave it at that. Thank you very much, sir. I appreciate that. Stephanie, there's a major conflict and a war going on in Ukraine. Can you tell us a little bit about how the economy has dealt with these types of conflicts in the past, and then maybe we could talk a little bit more specifically
Sure.
about this particular, what's going on with this conflict.
Of course, of course. On the screen, actually, everybody should be a nice line graph that really takes us back and shows us the major periods of conflict and wars that we've seen kind of in the modern day. And you can see some small, as Josh was saying, some small blips, some short-term changes and short-term declines around these events. But what you're really seeing is the market's ability to rebound and the market's ability to power through these geopolitical issues and perpetually trend upwards. With that being said, we are still very optimistic, about the U.S. markets and not so much now on Europe. Previous to this conflict beginning, analysts were pretty bullish on Europe in general. We were all starting to recover from the supply chain issues that lingered from COVID. However, unfortunately, here at the end of February, we now entered into a period of war. We now have sanctions and we have bans on exports from Russia. And although we seem to be seeing effects of that on U.S. soil, Greater Europe is really going to see the vast majority of the effects of these sanctions. And unfortunately, as the supply chain was starting to recover, we're kind of backsliding just in general. So the good news is Russia as a nation only produces about 12% of the entire globe's crude oil. We saw a lot of increases in gas prices here on U.S. soil, but those are not solely attributed to the ban on Russian oil. So that's something it's actually a positive because it means those things are a little bit more in the control of the U.S. versus overseas. And actually the biggest export out of Russia is tied into what Josh was just talking about, which is the commodities sector of the economy. They are actually the number one producer of precious metal, palladium. And that's a portion of what makes up most commodities indices out there. So it's going to help drive that a little bit. So kind of in short, we already scaled back preemptively our exposure to international investments at the end of 2021. And we actually steered completely away from emerging markets, including China and Russia, at the very end of February. So we do feel like our portfolio is really poised to do exactly what it should do, which is to be resilient and see the U.S. economy continue to be quite strong.
Thank you.
Yeah, I think Russia's 1/15 the size of the U.S. economy.
Exactly.
We have states bigger than their entire economy. It's interesting.
You just regardless of how terrible the war is, the one thing is Russia's influence on the global economy and certainly the U.S. economy, except for potentially some commodities, is rather insignificant.
Right. I think from like a humanitarian viewpoint, it seems a lot worse than it is in reality to our financial market outlook.
Sure. And likely the majority of the volatility we've seen is not necessarily the concern with regards to the Russian economy disrupting things, but the uncertainty of escalation. And that's certainly a scary piece, but not really because it's economic, but more humanitarian.
Right.
Well, we just hope it ends soon and we can get back to normal. But
Absolutely.
In the meantime, we have this inflation thing to deal with. So there has been a lot of news around this, and part of why we do these economics updates, folks, is to bring you the best information that we have at our fingertips right now as your trusted advisors. So we do appreciate you letting us speak to you in this manner, and we want to bring you the best that we have. But this inflation thing is something that's hitting all of us across the board, and we wanted to talk about that a little bit because we think that there are some very interesting points within the inflation that will help everybody understand it and deal better with it as they plan out their next 5 years financially. So you can see that our inflation rates have peaked up over 7% year over year, and that should be probably, from what analysts are saying, the next few years as these rates increase. But as we transition, I think that, and Steph, you could help me with this one here, it's very interesting, the sticky versus the flexible inflation. And
Yeah, I think this is actually really interesting. And when we think of inflation, I think it's really easy to just look at the items that you see day to day. Prices at the grocery store, prices at the pump, everything is significantly more expensive than it was 3 months ago. But when you really look at inflation and what's driving this number, there's actually multiple components. And I'm pretty sure most people haven't heard of these terms, and they are called sticky inflation versus flexible inflation. And sticky is kind of exactly what it sounds like, which is these are the things that are going to get more expensive and they're going to stick at those higher price points. Things like medical costs, insurance, rents. I don't recall ever hearing of somebody's rent being raised and then it subsequently being reduced. So that seems to that's a logical step from there. But the things that are flexible are the things that you're seeing most often, the grocery store prices, energy costs, things of those sort. They tend to increase very rapidly, so you feel it and you see it very quickly. However, they don't tend to stay. So when we're talking about inflation right now, we have a combination of these two. And the chart that's on the screen in front of you is actually, I think, visually really poignant because you can see the somewhat level line of the sticky inflationary items, and then you can see the rather volatile flexible items. And we're here on the end where those flexible items have just skyrocketed for everybody here in the first part of the year. And now when we look forward, those items should slowly start to return to normal. And analysts are really thinking that this inflation is going to stick around for a little bit, probably till around the end of 2023 before it reverts to those mean figures somewhere between 2 and 3%. So it should feel a lot more comfortable in the coming year or so.
Boy, that makes me feel a lot better, Josh. What about you?
Well, nobody likes inflation. The reality
That's right.
is we shouldn't be surprised, though.
Right.
This is another thing. If you go back to look at our updates we've had throughout the last couple of years,
Pretty overdue.
Yeah, it's been very low for
And
quite
another
some
point
time.
I felt interesting too. I mean, we've increased the M2 money supply by 40% in the past couple of years. Like we expected some level of inflation, but historically low rates, varying conflicts, coming out of a pandemic, supply chain disruptions, all of these have kind of perfect stormed into this inflation. However, looking at that, the inflation that's here to stay and the inflation that should go away after a few years is very important. So we would encourage everybody, make sure you're looking at your budget, right? This is a perfect time to put pencil to paper. We're finishing up tax season. Check out your budget, see what's your flexible and what's your sticky inflation and your expenses, and plan around it. And we're here to help you with that. So
Absolutely.
yeah. So anyway,
Good point.
so moving right along, another concern, and there was some interesting news around this just yesterday, but cybersecurity. So with the war in Ukraine, there were some a lot of folks saying, hey, there's a increased cybersecurity risk. So we first of all wanted to talk about what we're doing, what our partners are doing, and what you can be doing. But there was actually an increased uptick in that, and our Homeland Security thwarted a large malware attack just yesterday. So it's very telling of the way that wars are fought now, whether they're done in the political arena, the cyber arena, or boots on the ground. But it's something that we all need to take very seriously, and we would very much encourage you. And we understand, it's challenging at times with the technology, but we want to be as supportive as we can to keep you as safe and your information as safe as possible, because we really want to make sure everybody's as safe in this new age as we can. So what are we doing? So here, if you've noticed, we've changed up a couple of things on our website. We are looking at our encoding and our embedding of how you get access to your accounts here through our varying channels, how you upload files to us. Please do not email us sensitive files without putting a password on it or uploading it to our secure drops. We have secure drops for you to give us files in a secure way that we can manage that. And we would also encourage you to store your files safely at home so others can't get access to that. 2, our partners at New Edge and our broker dealer have upgraded their cybersecurity platform in quite a few ways. And if you're familiar with Fidelity, we're pretty much partnered with Fidelity, and they lead the industry as far as cybersecurity, in our opinion. But we do keep up with them and their updates, and if there's anything that you need to be aware of, make sure you're engaged with us so you can see those updates. And lastly, what you can be doing. So we've led webinars in the past on cybersecurity. We would encourage you to go check those out in our resource section, and we do plan on bringing out some more updated versions of those. But good passwords in a safe place and good solid document retention, I think is, and don't be accessing public networks if at all possible. Use your own network. So I think those are our kind of quick things we tell everybody. But
Agreed.
if you have questions or need a little bit of help, we are here for that as well, because staying secure is almost as important as anything else. So anyway, just wanted to touch on that. So all right, let's go in. What are we taking action on? So we made some changes around, some general changes around our portfolios. What are we seeing in the general markets, and what moves are we thinking are appropriate?
Well, we're always monitoring and shifting parts of the portfolio as we feel needed, but we did have an additional rebalance recently for many of our accounts that specifically were holding emerging market positions. Emerging markets are generally going to be non-developed international countries, primarily China, but it could include Taiwan, Brazil, India, Russia, and so we essentially eliminated those positions almost entirely, and even though they held almost no Russia to begin with, we just felt that the inherent risk of having some non-developed overexposure or exposure in general was probably just not worth the risk. So in many portfolios that held those emerging positions, we did eliminate those. We were already underway in many of our portfolios developed international, which is going to be primarily Europe.
Right.
We're holding to those positions for now, but I would call them on somewhat of a high alert. Although our exposure to them is reasonable to begin with. We have experienced somewhat of a shift from growth to value here domestically in the U.S. Growth is going to be a little bit more what you would consider like your tech companies, where value is going to be more like your traditional blue chip, strong balance sheet companies. Typically, those value type companies are less volatile in volatile markets than growth companies. So we've somewhat had a bit of a shift to those, which we hope will manage a little bit of the volatility. And then on the bond side, we have made some adjustments a while ago in anticipation of rising rates and inflation, where we are actually underweight a fair amount of our fixed income portfolio and have reinvested those in what we call alternative assets. And alternative doesn't mean risky. In fact, it's the opposite. It's the same kind of measuring that a bond would have from a volatility perspective, but much, much more complex than what you're going to get in a traditional bond investment, where it's going to have less sensitivity to interest rate increase. And thus far, those have held well, while bonds have kind of picked up in their volatility. So we like those positions. We're even considering increasing those a bit. We don't want to go too far, certainly, and make decisions on the short term. But anything we can do to diversify out some bond volatility, we're going to continue to look at without building in more risk to the portfolio.
Risk first, return. Yeah, I like it. Thank you. Well, we're looking forward. There's some positives on the horizon, we think, but we wanted to give you some things to keep in mind as we look forward into the next quarter. So first things first, continued yet sustaining inflation, right? We've talked about the sticky versus the flexible, but we believe it will be here for at least a little while, so be prepared for that.
And one thing I think we should bring up.
Yeah.
Inflation doesn't necessarily correlate to negative stock market performance.
Absolutely.
Right.
Absolutely.
It doesn't mean that there can't be negative stock market performance, but we feel very confident that for the next several years we're going to see higher inflation than we've seen in a long time. But there's a lot of other things that go into play that are much more important to determine whether the stock market will do well than just inflation specifically. So we don't have to get into too many of those details right now, but don't think just because we feel very strongly that we're not going to go down to pre-COVID inflation, that we expect there to be a significant bear market for a prolonged period of time.
Good point.
There could be, but they're not directly correlated.
Correct. But we do expect perhaps some volatility in these markets.
Still volatility, absolutely.
Volatility indexes are up, and we expect a lot of money to be moving around. So
and if anything, though, volatility could be buying opportunities.
That's well, good point. So with these supply chain disruptions, right? So people can get things, maybe not as fast as they were used to, but we're dealing with that, right? The ships aren't piled up in the harbors. But what we're looking for here is there's a lot of cash as well. When we talked about that empty money supply, a lot of those dollars have yet to find a home, and they're losing quite a bit in these cash accounts, right? I mean, the money markets, the depositor accounts are high. Those dollars are going to find a home somewhere because they're inherently losing in these higher inflationary environments. They can't just hunker down. So do we think there's probably some cash heading for varying markets, whether it's alternatives, real estate, this equity market, the bond market as the rates increase? I mean, there's people are looking for opportunities right now. When they find them, that money will start to flow again.
Right.
And then lastly, these interest rate increases, right? So if you, and this is where we say, hey, as we look forward with your financial planning, if you are in a position to refinance some debt or make a large purchase, this may be the last chance you have for that. Although as interest rates more than likely increase, we will have more profitable bonds to purchase. So it's that give and the take where, well, we've gotten very low interest rates for lending personally over the past, I feel old saying this, but since '08 and the past 16 years or so, 15 years. But now that tide is shifting and we're heading into a hawkish Fed where they are going to expand the interest rates and raise them. So that will play into that. So that's why we do financial planning, and it's not just one number to rule them all. So
Right.
I think it's very interesting time, and there's a lot of things in motion which create opportunities. So
Yeah, and you mentioned, in terms of planning, I think one of the biggest things to mention is to just stick with your plan. Talk with your advisor. Avoid the emotional decision making. If you're feeling concerned, which actually it makes sense. We went through a pandemic, and now we're in a period of a lot of unrest, and a lot of things are going on that haven't been happening for the past, 5 to 10 years. So it's very, very normal, I think, for people to feel nervous right now.
very healthy.
Absolutely. So we can just try to avoid the emotional decision making, avoid trying to time the market, stay the course, sound portfolio, sound financial theory. I think everyone's going to be just fine.
Excellent point.
Yeah.
Excellent point. I knew we brought you on. Yeah, that's good.
It always seems
The feel good part, right?
That's right.
it always seems different, right? Like any current event seems like, oh, this is the time that it's gonna like all be crazy, or this is
always different.
Yeah,
That's what they always told
it
me.
always feels different. It always seems different. It never has been.
I love looking at the old Time covers, right? Time magazine covers from all the years back, and like look at all the things we made it through as humans, and we figure it out every time somehow. So
And the markets certainly do.
dang
Right.
right,
Yeah.
dang right.
We are
So-
resilient, as are the markets.
So what else? We gave you guys a lot, and we very much appreciate your time today. Please engage with us. We are very much trying to bring out good, timely content for you and good tips, tactics, strategies, insights, updates, all that stuff. So if you haven't already, please engage with us online, either on our website, our social media accounts, or just reach out to the office and we'll get you tagged into everything and on our lists. And if you know somebody that would find this beneficial, please share it with them. There's no lock on good, solid advice, and we put this out to the public so everybody can get access to it. But we do appreciate you viewing it, watching it, liking, subscribing, and joining us next time. So thank you, everybody, for your time today. We hope this was a beneficial quarterly economic update, and we'll see you next quarter. All right.
Thank you.
All right.